Okay. All right. Well, good evening, everyone. Welcome to Real Estate Investing with Anna and Peter. So I am your host, Anna Tan, and this is the other host, Peter Tan. Sorry, I had to kind of make it a little cheesy. So we are really excited to just talk to you a little bit about our real estate journey and what are some of the benefits um, that you can have and take the opportunity to also benefit from what we've learned specifically in commercial real estate. So let's see. Is that it? Okay, 1 second. Sorry, guys.
All right, can you guys see the slides?
There it goes. Okay, so just a disclaimer, we are not tax professionals, but we are engineers and we've done a lot of research. So I guess the main point is, feel free to do your own due diligence and contact any professional advisors before making an investment decision. So everything contained in this presentation is based on our opinion and our research. Right, so today what we'll cover is a little bit about us, why we chose commercial family and our journey there, what our strategy is in the multifamily space. So there's actually a couple of different strategies that you can do. And of course, what type of market, what type of properties we're looking at. And of course, what the hell is apartment syndication? And then we'll take a look at some deal structures, fees, some of the tax advantages, and then how do you get involved, and how do you invest? So a little bit about us. We are engineers. We currently live in Midland, Texas. We have invested in real estate for 10 years now. We own 6 single-family rental homes, and we are seeing actually really good cash returns on those. We've also have done private money lending, we've done a fix and flip. Peter was actually a pseudo real estate agent. He actually sold that fix and flip himself. And we've also more recently invested in over 500 multifamily units across 2 states. So you can see from at least our real estate resume, we have done quite a lot and experienced quite a bit. And now we're in a moment in our lives where we feel that commercial multifamily is the right way or the best way to do it right now. And what you also see is based on our returns for a single family, we have achieved really great returns on those. But what you're not seeing is a lot of the sweat equity that has gone into doing that. So a lot of late nights, a lot of weekends. So we'll kind of talk about that as well.
Nope. All right, guys. So why commercial multifamily? So we think commercial multifamily is the perfect investment. So for us, one of the big key things is it's 100% passive income, right? So we're not dealing with tenants, we're not dealing with toilets, we're not dealing with trash. And like Anna said, we've been in that single family space, we've done fix and flips, and those numbers that we show, 20% cash on cash, 56% annualized returns, those are fantastic numbers, but like Anna said, it doesn't show how much sweat equity went into driving those numbers. So we got 2 kids now. We're really busy. We both have W-2 jobs, full-time jobs. So we're looking for something more passive. The other reason we're moving into multifamily is because it offers scale. So it's a lot of work to find one property at a time, a single family house, right? So instead of just buying one house, spending a couple of months to find one house, we spend a couple of months to find a 260 unit apartment complex that we can deploy cash quickly. So that's one of the reasons why we're into multifamily. So the other big reason that we're going into multifamily is the ability to force appreciate. So we can go in, I guess the best way to describe it is commercial multifamily is valued based on the net operating income. So if we go in there and we increase the NOI, then we'll be able to increase the value of the property when we go to sell. And the third reason, this is one of our favorites, is the tax benefits. So guys, our government gives us incentives to provide housing. So that's one of the reasons why apartment complexes have some of the best tax benefits. So what we do with apartments is we go in and we do a cost seg study, a cost segregation study, and that really just takes all of the assets and breaks it down into the right classification and recovery period for taxes. And then what we have right now with the Tax Cut and Jobs Act passed several years ago is bonus depreciation. So we can take all of the 20-year items or less and bring that all into the first year. So you can get massive tax benefits and be able to utilize a tax deferral strategy that's really going to help your investment grow. And we're going to dig into that a little bit later in the presentation. So a lot of people do stocks. We're still in stocks. We have RSUs, different. I still do a lot of stocks, right? But actually, over 50% of our portfolio now is real estate. So there's pros and cons to each. Like I just mentioned, real estate, you get tax benefits. You're able to use leverage responsibly, right? So we're able to calculate what the cash flow is and what our debt service cost is, and we can use leverage in a safe way. And then there's property appreciation. And one thing that you don't really get from stocks is cash flow. So that's kind of unique to real estate. You do get dividends, you're looking at 1, 2, 3% S&P 500. But with real estate, I'm looking at 10, 15, 20% in cash flow. So just talking about the cons a little bit, for real estate, it's not liquid. So once you're in, you're in. That's one of the pros of stocks. You can kind of click. You can go on there in Robinhood and buy, sell, buy, sell. But it's also very volatile. You get 50% drawdowns in stocks. And so if you look at that chart in the middle, a 20-year risk return profile, annualized risk for real estate or standard deviation volatility is, it's right in there with government bonds and corporate bonds, while your total, annualized returns are up there around 9, 10%, very similar to large cap stocks and small cap stocks. And if you guys get into the world of syndication, which we're going to talk about later, you're going to find that annualized total returns on some of these investments are well above 10%. So guys, let's talk about different strategies in multifamily. So there's three different ones that I guess we can talk about tonight. The first one is going in and buying a distressed property. So those are like properties where your occupancy is below 85%, has poor operations, tenant issues, it's outdated, and it's usually in a less desirable location, right? But this is a high risk, high reward strategy. There's a likelihood that you can lose your entire investment, all right? And then we have the turnkey properties. So these are properties that are already stabilized, over 95% occupied, and they're fully remodeled to market standards, right? This is kind of like your A-class property in downtown. So these properties are, in terms of risk, very low. So people buy these for capital preservation. And your returns, guys, at sale are also going to be very low because it's very difficult to add value to increase the NOI on these types of properties. So where do we sit in our multifamily strategy? We're in the value add space. So we're looking for properties that are usually stabilized above 85%. We prefer 90% or higher. And then the units themselves are usually a little bit outdated. So a little bit below, and the rents are below market rents. So for these properties, we're already buying a cash flowing business. So the risk is very low in terms of losing your initial investment. But there's really strong upside on these types of investments because we can go in there, We can upgrade the units, improve them, put new flooring, fresh paint, new countertops, and drive the net operating income. And we'll show you a little bit later how that impacts the value of that property at sale. All right, so before I keep on talking here, probably want to talk about a few things here that maybe kind of explain the commercial multifamily space. So one thing that kind of measures the value of cash flow right now is cap rate. So cap rate is your net operating income, which is revenue minus expenses divided by the purchase price. So, for example, if you were to buy a property cash with no debt, your cap rate might be like 5%. And that would mean you're getting a 5% return on that cash. Okay. So, guys, if there's something that you guys don't understand, feel free to maybe type it in the chat box, and we'll be able to come back and answer those questions for you. See if there's anything in the chat box at the moment. All right, so we're all good. So here's an example of forced appreciation, guys. So let's assume we went in and we bought a 100-unit apartment complex for $10 million at a 5 cap. So what does all that mean? So for $10 million, that property is going to be generating $500,000 in income a year. All right. So let's go in and make a couple more assumptions to kind of illustrate how we force appreciate. We're going to finance that property at 75% loan to value. So if it's a $10 million property, we're taking a $7.5 million loan. And then we're going to bring in 25% of the equity. So, if you're looking at like single family homes, or when you go buy your house, that's 25% equity is, like your down payment. So in this case, it'll be $2.5 million of that $10 million. So we're leveraged 75 to 25 here. So we're going to go in and we're going to upgrade all 100 units of that apartment complex and hypothetically increase the rents $100 a month. And this is something that value add investors do day in and day out. So it's not unlikely. It's actually pretty normal to see $100 a month increase in rent. So we'll rehab those units at $5,000 per door, or for all 100 units, that's $500,000. And we're going to assume expenses stay flat. So just doing a little simple math, 100 units times $100 a month times 12 months, that's an increase of $120,000 in NOI. So what does that do for the value of that property? So we take the $120,000, that's your NOI, divided by your cap rate, which current cap rates are anywhere between 5 and 6 in the Houston market, and depending on the submarket and the class of property, but we're going to use 5 in this instance. That's $2.4 million in value creation, which is huge, right? For $100 in rental increase per unit. So if we just take that $2.4 million divided by the initial down payment plus the $500,000 that we brought in to rehab the property, that's an 80% returns on this investment. And yeah, that's the value creation at sale. And in our projects, you're going to see higher returns than that because of cash flow distributions. So your returns are going to be in excess of 80% in this type of example. We didn't include the cash flow.
So we know that in real estate, people is pretty much what contributes to the success in this industry. And property management is a key factor in the success of multifamily or commercial or apartments. So one thing that we also look for is, can a property be better if we change out property management? So something that we look for is, so one of the reasons why property management is so important is if you have poor property management, they may have really poor tenant screening, like they're not bringing in the right tenants for the property, like they might not be able to pay rent in time. Two, if they are employing inefficient operations, if they aren't enforcing community regulations, or they're just not paying attention to the market and the needs of the tenant. So that's really important, just making sure you have really positive reviews for property, because that's, who wants to go to a 2.5 star apartment when you can go to a five star? So property management is really important in the multifamily space, along with any other type of real estate asset.
And it's one of those things that as we're searching for an apartment complex to purchase, this is an area that we're looking to see what the deficiencies are, and if we can identify the issues and how we can bring solutions to the table. That's part of the value add process, right? So if we can identify it, that's how we make money. Okay, so let's talk about market and location. So we all know in real estate, market is really important. Location, 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 right? So when we're looking for a market, place to invest, we're looking for high population growth, high job growth, low inventory, limited supply. When we look at our CoStar reports, we want to see decreasing vacancy over the last couple of years. That means people are moving in here. There's household creation in that area. And then we want to be in a landlord-friendly environment. So if our tenants aren't paying, we need to be able to move them out and bring in someone that is paying. No rent caps, right? We don't want to be in California. And you want to be in a market that has diversified industries, so you're recession resistant, okay? So where does that all lead us to? Texas, right? So, in the infographics on the right, we got a quarterly apartment report. This is from CoStar and the Texas Real Estate Research Center at Texas A&M University. So just looking at the last quarter, and these are numbers from the last quarter, these numbers are a lot higher today. I just sat down in another real estate presentation with Madera and Charlie Young's team over in Lubbock, and what they're reporting is much, much higher. So like back in Q2, we had rent growth in Dallas of 9 to 11%. That number now is like 15%. And in Austin, we have rent growth, asking rent of like 13 and 16% back in Q2. That number is close to 20%. And Houston right now is almost 11% in terms of rent growth over the last 12 months. And then we also see occupancy rates increase. So why is that? So over the next 5 years, this comes from Marcus and Millichap's research. We're looking at tremendous growth across the Sunbelt states. So that's all of the southern states right there: Salt Lake City or Las Vegas, Phoenix, all of the Texas metros, Atlanta, Charlotte, Raleigh, and even Florida, right? But in terms of projections on rent growth, or not rent growth, population growth, Texas has 4 of the top 10 metros. So everyone is migrating. Right now we're going through some migration in the US. People are moving from the northeast, on the coast, and California, where living costs are really high. They're moving to Texas because we have jobs and it's affordable. So this migration, it's what's causing the rent growth, and you have household creation, and that's going to improve not only the rent growth but our vacancy.
So we talked about the right market, but we also need to find the right property. So in multifamily or commercial multifamily, we can kind of categorize apartments into 4 different classes: A, B, C, and D. So A tends to be the newer class, the shiny quarter. Those are the nice and fancy ones, typically built in maybe the last 15 years. B and C are the units that have been around for 15, 30 years or so, a little bit outdated, or the ones we're looking for hopefully are much more outdated. And then Class D, they're much older buildings in challenging neighborhoods with a lot of deferred maintenance. And those are the properties that we like to stay away from just because they're in a demographic that we would, they're just a little bit more challenging in those areas. So in the end, what we're really looking for and what our sweet spot is, because we're the SuiteLife, what we're looking for is offset markets or offset comps that are about 90% occupied and that they have higher rents than the existing property that we're interested in. Something else that we're looking at is for the existing property that we're interested in is more than 85% occupied, meaning it's stabilized, and we know that it has good, strong current cash flow. So if you remember, Peter kind of mentioned this is like a business and we're treating it like a business. So we're looking for something that has current, strong cash flow, and you would have to try really hard to break and lose money on it. So that's what we're looking for. Another thing that we're looking for in apartments is something with good bones, with minimal deferred maintenance, so that we can spend the dollars towards revenue projects, revenue increasing projects like doing upgrades in the interior. That way you can increase the rent. So we want to do those types of projects that will bring you revenue and increase your NOI.
Yeah, like fixing the roof, repairing plumbing, and changing out the water heater, or those deferred maintenance aren't going to increase your NOI. So we want to make sure that the property we're buying usually has very minimal deferred maintenance.
So the three things that we look for is reducing expense, increasing revenue, and improving the existing property management.
All right, guys. So what's an apartment syndication? Basically, an apartment syndication is just a fancy term for pulling money together as a group and from numerous investors to go buy something. And in this case, we're going to be buying an apartment complex. So this whole process is regulated by the Security Exchange Commission. And we're going to talk about, what we're raising under. In this case, we generally raise using the SEC 506B. But what this does is it just allows us as, ordinary people to be able to be a part of a large multifamily complex. In the past, these are, reserved for institutional investors, but by syndicating, we can leverage each other's time, each other's money, and be able to jump into something with economies of scale, right? And the beautiful thing with economy of scale is like we mentioned in the past is these big properties, we can afford property management to help keep it passive for us. We can afford employees, right? So on a 5-unit or 250 unit apartment complex, you might have 5-6 employees on site. So these are the nice things that, having one single family home doesn't provide you. So I can put 50,000 in a single family home and I'd have to work at it, or I can put 50,000 into a multifamily syndication and I get to stay at home and collect a paid cash flow, some distributions. So we kind of wanted to show you guys here on this slide, just kind of a diagram. So usually in the syndications you have, in these syndications that we do a GP, which is general partners. That's the sponsors, the active investors. They bring the deal together. They bring the debt on the right, which can come in the form of an agency or a bridge loan, and we bring in the equity. We help other investors join in on this deal, and the passive investors are called your limited partners. So we bring everything together to make this deal happen. So there are a lot of different ways to structure a deal. So if you guys get out into the syndication space, you'll see things with waterfalls, preferred returns, but we prefer to keep it simple. We like to do what we call an 80-20 straight split. Sometimes these are 70-30, 60-40, but we're syndicating using 80-20 splits. So what does that mean? So for pretty much for every dollar, or let's say $100 that the business brings in, $20 goes to the general partner, and $80 would go to the limited partners. And we're just talking about cash flow while we're running that business. So, and then at disposition, at sale, first we're going to return the limited partners' initial capital contributions, and then we'll do an 80-20 split. So all the profits after that, we're going to split 80 to the limited partners and 20% to the GPs. So I think a lot of people might ask, okay, what does the general partners do? What do they do to earn their 20%? I'm going to let Anna talk a little bit about that on the next slide.
Okay, so this is just an overview of the general, I guess, syndication or apartment purchase process. So I kind of have 4 different milestones. The first one is property acquisition, where the LOI or the letter of intent and the purchase sale agreement is signed. But what you don't see before this milestone is reached is all of the pre-work. You have to kind of go around, talk to different brokers, make the relationships, find the property, do underwriting, basically analyze the property. And if you kind of think about finding a needle in a haystack, it's almost kind of like that. Like you go through a lot of different properties before you find the right one. So that's part of it. So before you even get to part 1, that's kind of the initial work that you have to do. So once you do find the property, you're basically you have to bid. So you're bidding against other folks that are interested in the same property. So you have to go back and kind of refine your data, refine your purchase price, and come up with your business plan while you're doing this. So kind of moving forward, milestone 1 is reached, the LOI PSA is signed. What we move to is milestone number 2 is finding the funds in equity and debt. So equity is where you guys come in as the potential passive investor. You look at the deal, see if you like it, and invest. And the debt, so meanwhile we're kind of doing all this, the sponsor is also seeking the debt, whether through an agency or a bridge loan. There's a lot of requirements that's required there. We won't go too much into detail there. But once we get all the funding, go through an SEC lawyer, kind of come up with the organizational structure, create the LLC, all the kind of the legal paperwork. We go to milestone number 3. The property is finally closed, it's funded, and new ownership takes over the property. So once it takes over, this is when the business plan is implemented. Generally, the first 6 months, we'll take over, can implement the business plan, and generally you won't see the distributions because we're focusing on the property and just kind of making those quick changes, because the faster you can make the change with your CapEx dollars, the faster you'll be able to see the returns, and that's what we want. So usually about after 6 months, you'll start seeing the distributions from the cash flow. So you can kind of see, at that point in time, that's when you start receiving in the GP as well. The 4th milestone is the property will be sold after a certain hold period. And that is going to be determined based on how quickly the existing management is able to execute the business plan, what the current market is. So if the plan initially was to hold it for 5 years and there's an opportunity to sell it in 3, well, hell, we're gonna sell it in 3 and double your money in 3 years. So we're gonna be kind of looking at that at that. So upon that, as Peter mentioned before, that's when you'll also get the return of capital and the percent of the profits. So just want to try and list a couple of different fees that can be charged for some of the work that we're presenting today. For us, we will typically be on the lower side of the typical industry standard. So you have acquisition, asset management, disposition, a refinance fee, and construction. And typically we'll only kind of just focus on maybe the top 2 or 3, and we generally won't charge the last 2. So again, just kind of reiterating the acquisition fee. as I kind of mentioned before, in the previous slide, you kind of have a lot of the pre-work before the LOI and the PSA gets signed. That just kind of helps cover some of those costs. And the asset management kind of just manages the property and the property management over the whole period.
All right, so this is probably my favorite slide. So there's, like I mentioned, there's tax advantages to investing in real estate, and a lot of that comes from depreciation, bonus depreciation, and going through a cost seg study. So what I kind of wanted to model here and give you guys an example of is a $100,000 initial investment in year zero. And we're gonna assume that your tax rate is 35%. And if and generally the depreciation that you're gonna get out of a $100,000 investment might be somewhere between 70 to 80% of your initial investment. Sometimes that could be 100%, just depending on the loan to equity ratio or how much equity is being brought to that deal. But we're going to go with 80% bonus depreciation and a 35% top tax rate here. So in year one, you would save $28,000, and you're not really saving it. You're deferring those taxes to when you sell. All right. And then what we're going to do is we're going to assume a 10% growth rate for 10 years for both types of investments, stocks and a multifamily investment. And then we're going to sell both of those investments in year 10. Okay. And then we're going to look at the taxes, long-term capital gains. And then what we have is when at sale, the IRS charges a 25% depreciation recapture on the depreciation that you took. Usually there's depreciations in years 2, 3, 4, and there's going to be depreciation throughout the investment, because you still have your 20 to 40 year property in the investment. But just kind of simplify this, we're just deferring that year one depreciation. So even going back and charging taking 15% long-term capital gains on both multifamily and stocks, and then doing the 25% depreciation recapture, you're still going to net $36,000 more on the multifamily investment over stocks. So, and then another strategy that people deploy is they just roll that investment. So you take your capital gains and your original investment, and you put it in another multifamily investment, and you take those depreciation at that point in year 10 to cancel out your capital gains. So you can continue to grow your investment tax deferred for a really, really long time until death if you want to, and just live off the cash flow. And that's a strategy that we're deploying in our personal investments. So I like to call this the infinite IRA, right? So you're not having to, there's no cap on how much you can invest, and there's, you're able to kind of push this out, as long as you keep on continuing to invest in another real estate assets with depreciation.
So Peter, are you telling me that on this example, the net profit of $171,000 and the $53,000, you can just roll it into another real estate and not pay any taxes?
You could. So you can definitely decrease a lot of those capital gains just by using the depreciation from the next property you invest in. Of course, laws can change, but current laws right now allow us to do that. So definitely check with your CPA on this advice.
Right. So I think this is yours too.
Okay. So who can invest? So guys, we raise using SEC Reg 506B. What 506B allows us to bring in both accredited investors and non-accredited investors, but they have to be sophisticated. We're limited to 35 non-accredited investors in any raise. What's an accredited investor? So you can either make $200,000 a year over the past 2 years and expect to continue to do so as if you're single, or $300,000 if you're married. Or you have over $1 million in net worth, not including your primary residence. A sophisticated investor has knowledge and experience in financing and business matters and are able to accurately or effectively evaluate the merits of the deal. So you can source your investment with using a self-directed IRA. So if you have a 401k from a previous job and it's sitting in stocks or cash, or you don't know what to do with it, this is a great place to park those funds. So you can move it into, you can find a self-directed IRA custodian like Quest and get in touch with them. You want to do it at least a couple months or a month or so before the investment. It gives you time to get that set up and then have the custodian move the funds into the investment for you. So use what?
You can use cash.
You can use cash.
Or do a
or sell your stocks.
Cash out refi. So at the end of the day, if you're interested, how do you invest? Define what your goals are. Find an opportunity like us. We'll be providing opportunities. Attend the deal review the deal summary, attend the webinar, subscribe to the deal, and then review. Sign the PPM or the private placement memorandum, operating agreement, any other subscription documents. So those would be drafted by the SEC lawyer. And then finally, just fund the wires. Oh my gosh, wire the funds and invest. And that's pretty much it. It's pretty easy peasy. If you have any questions about future investments or just want to talk a little bit more, our contact's there. And we'll kind of have one little extra slide. So what I thought was really important, just to kind of understand some of the financial metrics, how are they calculated?